Welcome to Futures Now. I'm Jackie DeAngelis. We are coming to you live from the commodity desk at CNBC Global Headquarters. Here's what's coming up on today's show. Oil is up 5% this year, and one top strategist says there's one thing he's watching that could put a dent in this rally. Tom Kloza of the Oil Price Information Service will tell us what that is. Plus, the Bitcoin bust continues with the cryptocurrency now well below 7,000. And one of our traders says the worst is yet to come. He's going to give us that trade later on in the show. But first, let's start with the market. Stocks staging a big comeback today with all three major indices now up more than 4% from their lows on Monday. We've got Jim Urio and Jeff Kilberg coming to you from the floor of the CME. They are breaking down the market's moves. Jim, let's go ahead and start with you.
Remember how last week we talked a couple times how I didn't like those 2% rips higher without any follow through the next day? To me, that just kind of smacked of volatile, directionless market. One thing I do like is the way it defended the lows yesterday, reversed, and then built on that today. I think today and yesterday combined is a very positive move. And I'm not saying that means we're heading to new highs, but we have a heck of a lot of room to go within this big 2-month range we've set out already.
What do you think, Jeff?
I think it's sensational. We're dissecting hourly moves here, right? We saw just tremendous emotion in the tape, and that emotion, obviously an overreaction yesterday, but we have seen a follow through to Jimmy's point. But I don't think the volatility, despite the fact the VIX is down at 19, I don't think this volatile emotional tape is over with. I still think that we may go down and test those lows. We're just kind of sorting out what actually is going to transpire in this trade war. And the market right now feels like it's a little bit safe, but I think that's a little premature.
I think calling it a trade war, by the way, might be a little bit premature. Both sides posturing doesn't constitute a war. Yeah. Posturing, you'll call it.
I would call it more than posturing. China has said they will do whatever it takes to defend the threat. Thank you, Jackie.
Okay, all right. We'll agree to threat.
One Jackie, zero Uriel. Okay. Boom. We started the show properly.
All right. Let's get to our next guest because he's got little faith that today's big gains are actually signaling that there are better days ahead. Peter Boockvar, Chief Investment Officer at Bleakley Advisory Group, joins us on the phone with his bear case. Welcome to the show, Peter. Always great to have you.
Hi, Jackie. Thanks.
So why is it that you see more trouble ahead for these markets?
Well, I'm most concerned about interest rates and tightening monetary policy, not just here but also overseas. So beginning on Monday, the second quarter, the Fed is going to increase the amount of their balance sheet rundown to $90 billion, up from $60 in Q1 and $30 in Q4. Will be $120 in Q3 and $150 billion in Q4. So I look at that as a major liquidity drag, just as QE created a lot of ebullience and euphoria in the markets. I think behind the scenes, quantitative tightening is going to do the opposite. In addition to more rate hikes, look at European markets. It's no coincidence that they're down over the first 3 months of the year as the ECB cut QE by 50%. And even the Bank of Japan's in a subtle taper as they focus more on yield curve control. So to me, that is really the biggest backdrop to this market. And because of that, it creates vulnerabilities that when you throw in tariffs, when you throw in Facebook privacy issues, the markets just become more sensitive to valuations. They become more sensitive to issues out there when the monetary backdrop changes.
Right, Peter, when there's no more easy money and you stop spiking the punch bowl, I mean, we all were waiting for this day to come. It took a lot longer than some thought.
That's exactly right.
Also, your case, when you're looking at the market, you're saying investors have to get used to this kind of volatility, that it's going to be choppy trade for quite some time.
I mean, if you take out 2017, the average in the VIX going back to its 25-year plus history was 20. Yet last year was such an anomaly. So here the average quarter to date, or in the first quarter, is about 17. Now it feels different because it's not what we're used to, but volatility like this is actually more normal. But last year was such a strange occurrence that I think people have to understand that is almost a once-in-a-lifetime type of year.
Jim Urio?
Peter, usually you and I think a lot alike, and it troubles me when we don't. When I hear you say that the market can't handle slightly higher interest rates, if I paraphrase that and said you think the fundamentals of the underlying macroeconomic condition are garbage, is that kind of what you're saying? Or if the Fed slowed down or said maybe that we're going to be monitoring this closely, had more dovish language, would that help?
Well, no, the U.S. economy is okay, but let's look at two things. Let's look at the markets and then separate that from the economy for a second. It took a 30 basis point increase in the 10-year Treasury yield to blow up an entire $1 trillion-plus short volatility trade. That's all it was. It was 30 basis points. The 10-year closed on the last day of trading 2017 at 2.4. Once we crossed 270, all havoc took place. So to me, that was a canary in the sense that, when you're at zero interest rates for 7 years, when you quintuple the size of your balance sheet, you become addicted to that. It doesn't take much of a reversal to have a pronounced impact. I mean, let's look at LIBOR, for example, because I know that's a big topic. It's essentially doubled over the past year, and there are trillions of dollars of debt that is priced off LIBOR. And while this move so far is not going to, quote-unquote, tank the economy, it is raising the cost of capital for a lot of companies. At the same time where growth is okay, but 2.5% growth, it's better, but it's not this acceleration that we were hoping for. I'm bullish on the tax cuts. I'm happy that we're seeing regulatory relief, but there are offsets. The rise in interest expense, the rise in labor costs will completely offset the dollar reduction in the corporate income tax that companies pay.
Peter, Jeff Kilberg has a question for you.
Hey, Peter, question back to interest rates in the 10-year. We are certainly seeing a little bit of move in rates in the last 24 hours as these trade tariff tensions have eased. But the bigger question is the Fed. They want to see that long end of the curve in that 10-year go above 3% while that 2-year is creeping up. But what is the percentage in the 10-year where you really get concerned about equities? This seems just to be a little bit of a spasm here with this recent pullback in equities. But what's the real number in the 10-year? Is it 3.25%? Is it 3.5% where we see a real correction?
Well, 270, getting back to what I said earlier, 270 led to a 10% correction in the stock market. So, yeah, 3% just because it's a round number, I think is something that garners people's attention just as 270 did. But as you mentioned, it's also the rise in short-term interest rates that to me is very interesting, and that while the curve is flattening, it's flattening, but yields are still rising across the curve. And again, I just think that we're just very sensitive to changes in interest rates because we became so accustomed to this artificially low level of rates.
Peter, if the market's in trouble now, how much lower do you think we can go?
Well, I think in the short term, at least from the tariff perspective, I'm confident that cooler heads will prevail and there'll be some sort of deal. But if that happens, then we could get this resumption of higher interest rates, which would then concern the markets, and then start to retest the 2,500-ish type lows. We're late cycle. We're late cycle in the market. We're late cycle in the economy, and you have an intensification in the tightening of monetary policy, not just in the U.S., but every month that goes by, we're a month closer to the ECB ending quantitative easing. We're a step closer to them wanting to take away negative interest rates. Well, there's still trillions of dollars of global bonds that have negative yielding rates. So it's this rate environment that I think is becoming more of a headwind that really is my main concern.
Lots to worry about, Peter. We'll check in with you in some time and get your perspective again. Thank you.
Thank you.
Jim, let's get straight to you. You're trading the S&P. Peter's view is longer term, a little bit more negative, but this is futures now. So what do we want to do today?
Right. Yeah, I don't disagree with a lot of what Peter says, but I think we could easily rebound within the framework we set out over the last couple of months. We're trading right now 26.67. If we back off to 26.63 again, I think that's a spot to get long with a target of 26.85 on the upside, a stop place below 26.48. A little caveat here: if we keep rallying another 6 ticks and trade 26.73, I think that would be another spot to stop in with a long, and I'll be looking at that on Twitter and tweeting it out. I agree with a lot of Peter says. There's only a few people who I really listen to every word they say, and Peter's one of those guys.
Jeff
I think
is
that, and Jeff's the other, of course. But the transition from massively low interest rates to only kind of low interest rates is going to be clumsy and lack elegance, and we've seen that so far.
Well, there's so much
I agree with that 100%.
There's so much other noise right now. I think investors have lost focus on what could happen when the music stops and who's going to be left without a chair, right?
Yeah, but even with all that noise, I think the most important thing is the fact that the rates are going up. There's so many zombie companies that rely on rates being low to their interest debt is not enough. Their earnings are not enough to cover their interest payments, and I think that's going to be bad.
Well, Jackie, I'm not going to go into Peter's his playbook and ask for his resignation from futures now, but I do disagree with this trade. And the reason I disagree with this trade is that let's look at where the market was yesterday. We were 100 handles lower on the S&P 500. Buying it up here seems a little bit dangerous as the trade tariffs tensions have eased, but nothing really has changed with the dynamic and the relationship. We're a tweet away from President Trump moving this market 50
tweet away
handles
from
lower.
moving at 50 handles higher, too. I'm going to say this, is that
He has not
we were
tweeted
100
anything
handles.
positive.
We were 100
You're
handles
wrong.
lower yesterday. 100 handles seem like nothing in this current environment.
Wow.
We chewed through that in a second.
So that's my apprehension here in the trade. Buying it here after this type of move. What have we seen ever since Mnuchin basically talked about the dollar? We have seen 2% moves, 2% up and down. So right now I think the opportunity is to take it from the other side. So sold.
Understood.
All right,
That's how we make
Jim
a trade.
wants to get in. Jeff is apprehensive. Let's go get the risk reward on this trade. Jim is buying the S&P 2663. He's targeting a move to 2685. Each point is worth 50. He's risking 750 to make 1100 in this S&P E-mini trade. All right, let's turn to crude oil. The U.S. muscling out the competition with record exports of crude last week. That's even as OPEC wrestles with its own output. For what this means for the global oil market, Tom Kloza of the Oil Price Information Service joins us by phone. Tom, great to have you.
Hi, Jackie. How are you?
How do recent developments impact how you see oil moving for the rest of the year?
Well, I think the exports are what we need to focus on for the next 30 days. You know, May brings Iraqi elections, Venezuelan elections, perhaps the two new super hawks, John Bolton and Pompeo, into the White House and a tougher stance on Iran. But between now and then, we need to watch exports. We've never seen this before. The United States exported 15.25 million barrels onto the world market last week. We think that number is going to go up to probably 20 million or more, get to maybe 2.5 million barrels a day. So the United States is, in essence, going to be exporting more than the United Arab Emirates, Kuwait, Nigeria, those individual countries. So far, it's happened, and it hasn't really upset the overseas market for Brent. Brent is hanging in there. We think it's going to average about $67 a barrel or so this year, and it's a little bit above that right now. Mm-hmm. So this is what we need to watch. We need to watch gasoline exports, too, because right now you project that demand's going to go up about 6% with the driving season about a month from now. We're making too much gasoline for domestic usage, but the foreign export market is taking 1 million, and that's keeping everything balanced for now.
Tom, I know that crude oil itself was not on the list of tariffs that China has put out there. But we see crude really trading very closely with the stock market, and I think that's because of demand. So stocks go down, they're worried about a trade war. People are worried that there'll be less demand for crude oil. Is this something that's concerning?
Oh, it's the ultimate macroeconomic product. Crude oil to a certain extent, and the prognostications by Morgan Stanley and Goldman of sort of $70 or $80, that's priced for pure perfection, whether it's measured by PMI or whether it's measured by GDP. So any disappointments in that are going to result in sell-offs. And, there's the notion that this year is going to see 1.6 million barrels a day of additional global demand. Trade wars, any kind of a recession, any notion of any weakness in global economies are going to cut into that. So keep that in mind. Yeah. We might yet be priced for perfection, but perfection is a pretty difficult thing to see.
Right. Jim Uriel, question for Tom.
Tom, it sounds to me from listening to you now that 64 in your mind is a level where we turn on the spigots and try to produce as much as we can here because that's an attractive price. And let's assume that on the low side, I don't know, maybe 40 is when we start to turn the spigots off. And when you look at it, is there like an equilibrium range where that doesn't come into play? Is that in the mid 50s, low 50s? What is it?
Well, it's interesting that you mention that because I need to stress that in the Permian Basin, which is going to be our Iraq, right now the price of crude oil is about $6 under the futures price. So it's, 58.50 or so. And that means that we've exceeded the production, or we have more production than we have the capability of pipelines to remove it. And a lot of that stuff is going to the coast and is going to the world market. So we need to watch that number. It's not a number that you see high visibility on, but if you're in the Permian right now, you're probably singing Johnny Cash songs because you're looking for railroad to move that stuff up by train.
Well, Tom, speaking of singing songs, this is Jeff Kilberg in Chicago. It seems like OPEC is singing Kumbaya. Everyone's cooperating. We haven't really talked a lot about that. We're focused, obviously, on the production boost here domestically, but the curb of production by OPEC and non-OPEC members, will that persist, and how is that currently affecting the price of oil?
You know, I think the Persian Gulf countries are singing Kumbaya for a while, and they're probably hoping that Iran gets some sort of production suppressed by, the hawks in the cabinet coming in. The one sort of fly in the ointment is probably on the non-OPEC side from the Russians. They had the highest output in about 11 months, and, there's some hints that maybe they're not going to be in this long-term supply cutting agreement with the Saudis and whatever. So that'll be something to watch, but beyond that, we're going to see higher production from Kazakhstan, from Brazil, from the United States, and from Canada. Canadian imports into the United States are going to surpass 3 million barrels a day in the next few weeks or so. We've never seen that before.
So, Tom, what are the key levels to watch as we're sort of stuck at this 63 midpoint of the range?
I hate to say we're at equilibrium, and you started talking about volatility, but I think things are balanced for now. I think you need to watch gasoline. Gasoline is the Sherpa that usually takes crude oil higher in the spring, and it's really fighting to get back up to those yearly highs of about 208 to 210. If it doesn't do it, and we see a typical sort of second quarter sell-off, it's going to spell some trouble for crude because gasoline is the leader, even with much lighter volume than crude this time of year.
All right, Tom, great to talk to you. Thank you.
Thanks.
We'll talk to you soon. Jeff, you're trading oil for us out of that interview. Tom is suggesting that we could see some downside here. What's your thought?
Well, with all that talk of production boosting, I'm going to be a seller. Now, we had prices above $64 earlier this morning, so I want to be patient. I want to sell it at $64 in the crude oil May contract. Looking for a drop back down to $62.50. Seems a little bit of a range here. However, I want to be mindful in the event we get some more movement higher in the equity markets. It's going to correlate to the crude oil market. I'm stopped out at $65.
Okay. I don't hate this trade. I mean, this is futures really
don't
right
hate
now.
It, but you don't love it.
No, I don't love it, and I'll tell you why. I'll tell you why. No, it bounced off the longer-term trend line yesterday around 62 and change and defended that pretty well. To me, it means that the momentum's higher. I think it could come back and test 62.50.
Well, my target is exactly just a smidge above the trend line. I was going to say
that if you let me finish. It goes right above the trend line.
Moving complement ever.
However, the momentum to me is higher. The trade I would prefer to make is to buy it at 62.50 so we can both live comfortably. What's wrong with that?
Well, cats and dogs living together. I think it's wonderful. But remember, he's an equity bull right now. He just got put into his trade in the S&P 500. So, of course, he's going to want crude oil to go higher. Yeah. So I'm negative on both those short term. So that's why cats and dogs will live together.
We can live together. We can.
All right, let's get the risk.
You're the cat, I'm the dog. Let's be clear.
No, we're not clear on that.
Let's get the risk reward on this trade. Jeff is selling oil at 64. He's targeting a move to 62.50. Each point is $100. He's risking $1,000 to make $1,500, and we did not determine who the cat is and who the dog is. All right.
We will later.
Let's end with Bitcoin
we'll vote
now.
on Twitter.
Plunging well below 7,000. Jim, you see a bigger crash coming. It's interesting because every time we talk about it on the show, and we've been talking about it the last few weeks, it keeps going lower and lower.
Right. It was actually since they've introduced the futures contracts, it's gone lower and lower. I think since then, that validated them perhaps where they shouldn't have been validated as the winner in this whole thing. I think if it trades 65.80 in the April contract, which is a little lower than where it is now, that'll constitute a bit of a technical breakdown. I think that's a spot to get short with a target of 56.80 on the downside, a stop placed below 7,100. I fully am prepared for at some point in time there to be a spike higher with people thinking that this is the perfect time to get in. But I think the thing that I keep going back to is every time we see a headline, it's about regulation. And no country's ever going to say, you know what, I think I like Bitcoin. It should replace our currency.
Exactly.
That's not the way governments work. They like to have centralized currency. So I don't love Bitcoin.
Jeff?
Well, Jackie, they say in life there's two things you can count on: death and taxes. Well, there's actually three things. Death, taxes, and Jim shorting Bitcoin. So for all the haters out there, hop on. But I actually agree with them
too.
from
and
a technical
Scott
perspective.
would short it too. I'll speak for him.
Yes.
Scott's
no
looking
doubt.
for Bitcoin to go negative somehow. But Jimmy's trade here, there is some softness in the space. I get the technical breakdown, so I'm going to agree with him from a short-term perspective. But I do think longer term, all these governments, all this regulation actually emboldens and strengthens the cryptocurrencies.
This is the first time that I've heard 20,500 down to 6,600 be called a little bit of softness in the space. That's pretty much 2/3 of we've lost. And you call it softness. That's fine. That's fine.
It's not a recent softness.
Okay.
I think you're soft in the head right now.
Okay.
I was agreeing with your trade.
I know, but it's and you said crash too. It's gone down 2/3. It's lost 2/3
You
of
just
its
want to
value.
fight.
No, I don't want to
You're
fight.
upset that I called you the cat and I'm the dog.
Maybe.
Okay.
That's
Jim's
it.
the
We'll agree to
cat.
that.
He's got 9 lives. And Jeff,
No.
you're the dog.
Okay. Oh, okay. I like that.
Thank you. It would be weird if I was the cat and he was the dog. Let's just
Why?
agree
Why
on
would
that.
they- we'll talk
Maybe
about
we have
that.
the viewers weigh in.
Got it.
Let's get the risk reward on the Bitcoin trade, people. Jim is selling Bitcoin at 65.80. He's targeting a move down to 56.80. Each contract is 6,580, so he's risking $520 to make $900. I had to cut you guys off, or I mean, it was just never was going to end. That's going to do it for today's show. I'm Jackie DeAngelis. My thanks to Jim and Jeff. And you, if you missed anything, relax. We are on demand. The videos can be found right here at futuresnow.cnbc.com. For the latest headlines and a sneak peek of what's coming up on the next show, be sure to sign up for our newsletter at cnbc.com/futuresnow email. You can find a link to that and real-time trade updates on our Twitter account that's at CNBC Futures Now. The gentlemen will be updating their trades and suggesting ideas there. Meantime, our next live broadcast will be Tuesday at 1 p.m. Eastern right here, futuresnow.cnbc.com. See you next time.